We were just listening to the session before, and it was discussing the trading aspects and the market aspects of carbon legislations up to some extent. So let me ask you first, when we were preparing for this session, you told me that when you talk about barriers to decarbonizations, you put it on 3 layers: governments, public entities, and as well as intermediaries. Can you give us a brief about barriers for each, and which one do you think is the most important?
Thank you, May. Good morning, everyone. It's a pleasure to be here. I'm an economics consultant, and I do a lot of work in Europe on decarbonisation. So it's great to have this question to sort of get us started. I think in terms of the barriers to decarbonisation, it is very hard to talk about decarbonisation without thinking about carbon pricing, because when you are in this world of treating carbon as a commodity, as was being talked about, that's the point at which it will mature, and it will be a situation where when it can be traded, the negative externality can be priced, the incentives of people to reduce carbon can be aligned on a financial basis. That's the point at which it doesn't need so much centralization, oversight, and perhaps intervention to make it happen. But there's a long road to get there, as we were talking about in the previous panel. So the question you ask of what is the role of governments, of intermediaries, of policymakers, of regulators, I would say it's all. It's all in a multifaceted way in terms of all of the policy and regulatory frameworks need to be in place for investors to interact with, for financial capital to be incentivized to enter, and for carbon then to be, in a way, priced in the context of any decarbonisation incentives at source, as well as in the way of offsets.
So let's start this discussion with government role. And yeah. I know that usually when we talk about government's role, we focus on the government of the country itself. And we forget the fact that there should be some kind of coordination between global governments when it comes to decarbonization. Why do you think this is important, and to what extent are you happy and satisfied with what local governments in the MENA region are doing when it comes to making this shift to a decarbonized economy?
It's a great question, and I mean, I think if you asked any cross-section of individuals who are working in decarbonization or looking at climate policy and sustainability, and you said, what is the fabric that ties international governments together, somewhere in that answer you would get the Paris Agreement, you would get COP21, and you would get the sort of framework that was set up in that nearly a decade ago conversation as legally binding commitments. So I think let's start there in the context of how that filters through into the local governments. Because when you think about the Paris Agreement and you think about that overarching objective, Article 2, of we will keep the global temperature rise to well under 2 degrees, and then you think about Article 4, about we will create the nationally defined contribution plans, and Article 6, that we will have means of cooperating with each other. That's where a lot of the current effort in terms of decarbonisation sort of starts and has much more formal national as well as international agreements being agreed on the basis of that. I think the thing about the nationally defined contribution plans and about the conversations we were having on this stage just before you and I joined, May, is that a lot of the systems, both in terms of the localized solutions that governments are coming up with, as well as the ways in which they are interacting with each other, are still in a stage of the legally binding commitments came first, but the exact detailed implementation policies are yet to follow. So you think about plans for decarbonisation, and it really doesn't make sense to talk about international decarbonisation plans agnostic of the region, the country, the sector, and the value chain that you're thinking about. So any government, so we've worked with governments, we've worked with corporates that are trying to contribute to their national their nationally defined contribution plans. Any plan needs to begin with where are your own Scope 1, Scope 2, Scope 3 emissions? What are the parts that will have the greatest value to you in the context of if power generation is your biggest problem, focus on that and its value chain first. If heating and cooling is your biggest problem, focus on that and the exact technologies that will come to play. If it is about transport, what type of transport? What is the issue? Are you an island where you need to think about maritime and aviation? Or are you actually part of the European sort of interconnected rail and road, and you don't need to think as much perhaps as you do if you're an island? So it all begins with these plans which come from the detailed understanding of where your emissions are, and then what is the technology that you need up and down that value chain in order to deliver the decarbonisation of that sector. So that's the point at which you think about what's the upstream technology, does it exist? What's the midstream technology, the storage and the transport? And what are the engines and boilers and the use cases of it? It's by decarbonising in a very sector, region, sensitive kind of way that you will get to the right solution that is economically appropriate for you. And the role of government and of regulators is to allow that uncertainty around the right solution to be reduced in some way. And there's lots of aspects to that we can talk about.
So I'll get back to you on the part for technology, but we just discussed the role of governments when it comes to legal terms, legal framework. Now, does it work, in your opinion, to have a financial framework that is tied to the legal framework in the sense of tax credits, in the sense of certain pricing mechanism for carbon? Do these incentives work, in your opinion?
I mean, this is one of the really big questions in the context of compliance in voluntary markets. And you heard some opinions around this table before about whether or not compliance markets are effective, whether that sort of scrutiny is needed, whether voluntary markets are effective, and whether scrutiny is needed in order to make sure that the monitoring, reporting, verification is appropriate so that people have trust to enter it. And I think that actually there is a role for both. So let's take one step back in the context of what is it that you're trying to do. As an economist, when you think about the problem of decarbonisation that is before you, really the challenge is that if I go back to sort of first principles, the first line of a microeconomics textbook, economics is the allocation of scarce resources to meet unlimited wants. The environment is a scarce resource. It's been overconsumed in the sense of the carbon that has been freely emitted into it over at least 2 centuries, if not more, in the context of the concentration of the emissions that have been emitted has been in the context of the Industrial Revolution, but of course there was carbon being emitted before that as well. But you think about that as a free right that you had to pollute, to put carbon into the environment. And it is the production and consumption decision that you make as an agent, you and I, we produce, we consume, we have these actions, and in this case we're putting emissions into the air that are having a negative impact on others. But we're not priced for that. And the first best solution in economics textbook for a negative externality, a negative action that you're imposing on somebody else, the consequences of, is to price it, either by subsidizing the activity which is not causing pollution, or by taxing the activity that is causing pollution.
But how would you measure it?
Yeah. Precisely. Is it a voluntary or is it a sort of a compliance-based mechanism? Because if you're relying on voluntary reduction of or internalizing of the negative externality, then you're talking about me going to a farmer and saying, I would like you to plant more trees. That's at the most basic a voluntary sort of offset agreement that I am making with a farmer. Or you're saying, well, this is something what most people, when you talk about carbon pricing, would recognize as the carbon price, which is emissions trading scheme of some kind, a cap and trade system of some kind, a subset of a compliance-based market, where you now have something like 30 emissions trading schemes or compliance-based schemes sort of run by government and government authorities around the world, but they still cover about 25% of the world's emissions. The US is a very obvious missing market in that context. And the big question is then, how do you make those markets sufficiently liquid, deep, transparent, dynamic in their price formation so that you're getting the right signals to continuously decline your own emission creating activities? Because what we have seen is that the EU emissions trading scheme, which is quite mature, and the UK emissions trading scheme, which was created when Brexit happened and we were decoupled from the EU scheme, have had different price dynamics. The UK used to price at a higher price point because it had a tighter emissions target. Then, because of market and sort of supply and demand dynamics in the UK, that price declined. Is that a good thing? Because it's that question you're asking. How do you think about the pricing? When you are creating a government scheme and you are saying, here's the maximum emissions that you are allowed to generate, and then if you have excess emission allowances, you can trade them, you can't control the market demand and supply dynamics and ensure that they're always giving sharp incentives for decarbonisation to be happening at the margin. Because obviously those would be fluctuating with demand, and you do get the situation where both in terms of the voluntary market and in terms of the compliance-based market, you get this volatility in price signals. And the voluntary market is a lot more nascent, but it still happens in compliance-based markets as well. And we can also come back to this, but this question of what the price of carbon is when you think outside of the compliance-based schemes and think about negative emission technologies and how high the cost of carbon can be, that becomes a really interesting way of thinking about this really complex problem of how do you price this negative externality.
So we started this conversation with saying that when we talk about barriers to decarbonization, we said it's at 3 layers, governments, corporates, and intermediaries. We missed out another one, and it's the one that is changing the world, industries, how we live our daily lives, which is technology, and especially now with the hype around AI, artificial intelligence. So is, in your opinion, Sahar, technology and AI a factor that help or hinders when it comes to decarbonization?
I mean, it must be that you can't talk about decarbonization meaningfully without thinking about the technology at every level of that value chain that you're thinking about in a sector or in a region. I wouldn't even say it's a matter of help or hindrance. It's a matter of, it's an imperative. We need to understand how we are going to both abate at source as well as deal with the hard to abate sectors in terms of new technologies, and how we will, in a world where as much as possible the emissions have been reduced at source, still use high quality, perhaps engineered-based solutions like negative emission technologies in order to deal with that whole different tranches of carbon as you can see them. I mean, I think it is very hard to talk about this in the abstract, but let's just take one concrete example. Let's talk about one sector. You think about transport, and you say, okay, in a lot of the developed world, perhaps less so in developing economies, where the modes of transport may be less sort of emission intensive because the infrastructure is less developed. But in a lot of the developed world, transport is one of the big emitting sectors, and that's all sorts of transport. It's road transport, it's maritime transport, it's aviation, and you think about decarbonization, technology. What do you need in order to decarbonize transport? Huge question. You can write huge plans, and in fact sustainable transport plans are a large chunk of the nationally defined contribution plans that all of the countries that are signatories to the Paris Agreement are grappling with. But you think about Well, I need my technology upstream, the generation of the technologies that will enable me to have the batteries that are needed, or that will enable me to have the sustainable aviation fuels that are needed. That's all the upstream part. That is a non-trivial aspect of where a lot of the technology sort of focus goes at the moment in terms of sustainable aviation fuels, biofuels, limited at feedstock. What do we do? Can we make them more efficient? Can we do something else? Then you have the midstream, the transport of it, and depending on what you're transporting, whether it's a fuel or a liquid fuel or a gas, or you're changing its forms between the two in order to transport it over a certain infrastructure, a certain distance, whether it's piped, whether it's road transport, it's non-negligible whether or not you have the infrastructure in order to be able to transport it. If you want to transport hydrogen, you can't use iron mains pipes that are still in large parts of, well, they've been gradually replaced over time, but they were still in large parts of the UK sort of 10, 15 years ago. You can't transport hydrogen on iron mains pipes, so you need to replace them with plastic. You need to think about what are the fundamentals of this fuel type that mean that the technology that is supporting it, storing it, transporting it needs to change. And then finally, at the end point, at the point of consumption, there's two things. There's behavioral, which is the education and getting people to accept it, but there's also the can they feasibly, technologically accept it? And that's about engines and boilers and replacement there. So I think along that entire value chain, the upstream part, the midstream part, the downstream part, where it's being produced, stored, transported, and then consumed. You have technological innovation and AI as a facilitating wrapper in terms of smart grids, smart meters, better data to manage all of the logistics more efficiently. All of that is I wouldn't even say it's at the level of incremental transformation. It is, when you add it all up, revolutionary.
So, Sahar, you are a chartered financial analyst.
I am.
So you have a great financial background, and you know that for banks, for corporates, for investors as well, it's really about the risk-adjusted returns. And the reason why we're mentioning this, because when you want to spend billions of dollars on infrastructure, whether you go to a bank, whether you go to the investors, they're going to ask you, how much return are you expecting from this project, and how does it compare to costs? This is a legitimate question. So to what extent, Sahar, do you see from your financial background, do you see that today the returns that we can expect on these type of projects, decarbonization projects, are feasible and realistic and meaningful for investments?
I mean, it's a great question, because I think the issue that we are facing is that on the one hand, I have some investors, some of the biggest money managers in the world sort of saying, we're getting to a point where we are experiencing within our investment committee some ESG fatigue. You know, there's been talk about impact investing, about ESG related investing, about the sort of greenium and the returns that can be generated to sustainable investing being higher for so long that we're tired of talking about it. So on the one hand, you have this sort of idea that the financial markets are awash with capital. On the other hand, you're talking about the UNFCCC having said a couple of years ago now, in 2021, they did this quantification, which was terrifying, saying that for just 78 countries where they added up the climate plans, the NDCs of them, they had identified the financing needs of $5.8 trillion. And that was translating into a $600 billion per annum equivalent spending need on the sort of decarbonization and energy transition plans of these countries. At the same time, the total aggregate global climate flows that they identified were 640 billion up to that point in time. So you're talking about the total aggregate flows just about adding up to the annual required flow, and a huge shortfall relative to what was actually needed. And then you get into the thing about, well, where is all of this capital that everybody is experiencing sort of ESG fatigue around in the context of sustainable investment? And it's, currently about $3 trillion dollars that the UN Trade and Development Authority have quantified is sitting in sustainable funds. But the question and the challenge that you experience when you're talking to these funds is about where to deploy that capital. And the levels of uncertainties just compound. That which technology do we invest in? Because there's lots of competing technologies, and in reality they're doing a bit of a mixed bag. That they'll be investing in some renewables, they'll be investing in some negative emission technologies, they'll be investing in some AI and sort of enabling smart meters, etc. technologies. But that's one big question about where, especially if you have questions of competing technologies, where do we invest? Something like, I don't know, will there be hydrogen fuel cells or solid state electrical batteries that will be used in decarbonizing some heavy vehicles? That's the sort of question of, if you have a competing technology, diversification strategies obviously only go so far. You might end up losing capital. And that's where you're taking merchant risk, where you're investing in something which is unregulated. When it's regulated, you get into even more challenging situations of, has the regulator done enough to manage the risk that I'm facing on this asset to a level that is commensurate to the return that I expect I can generate on this regulated asset? And the way that investors have then put it to me is in the context of perhaps they own a gas network somewhere and they're concerned about its stranding risk, in the context of we might not have natural gas as the means of domestic heating in 2050. Certainly if we want to be compliant with net zero goals, that would suggest that we do need to be transitioning away from that. But they say, will it be hydrogen for domestic heating? I don't really know. But unless the regulator can give me enough certainty, I'm not going to take a 20% risk for a 4% return.
And I have to add something here, that when we look at the economic environment in the past few years following COVID, so we're talking about very high interest rates, which is hindering to a great extent the borrowing activity, whether of governments or to corporates. And the second thing is priorities for governments were different, and especially following COVID. And that actually created more strain on governments that have to balance their priorities between decarbonization and at the same time supporting their economies, which brings me to intermediaries.
Yeah.
And when we talk about intermediaries, Sahar, do we only mean banks, financial institutions, or are there other parties who are considered intermediaries when it comes to decarbonization and providing the financing needed?
I mean, I think let's think of that question holistically, May, in the context of, yes, there's absolutely other intermediaries. In fact, I find it more helpful to think about all of the stakeholders in this ecosystem around, once you pick a particular segment that you're trying to decarbonize, so a particular sector, and you think about its value chain. There will be banks, there will be financiers, there'll also be asset managers, there'll be asset owners, there'll be the lawyers in the context of perhaps negotiating with some governments and trying to get some of the risk managed in the context of one of the live questions right now in carbon capture is, if you're investing in these carbon capture storage networks and you are taking a risk that this permanent geological store that you are trying to inject the carbon into may at some point, many decades, possibly centuries later, have some liability in association with leakage, who bears that risk? A large part of that is the sort of legal terms and conditions that are being worked out with governments in the context of what are the subsidies or the insurances that the government can provide. So lawyers are part of that ecosystem, consultants of various kinds, technical engineering. So let's park the issue at the moment of the intermediaries and think about that wider question that you ask of how are the priorities changing with COVID. And I think it's extremely important to think about this as, yes, COVID did create issues around funding and sort of appetites in central governments and perhaps regional governments as well to allocate funds towards decarbonization. But in a way, I find COVID is only one of a series of macroeconomic sort of factors that create trade-offs, because really the fundamental trade-off which we talk about in the energy sector, but I just heard somebody talking about it in the food agriculture sector in the other panel, and I've heard about it talked about in transport as well. The trilemma that we face is it needs to be affordable, it needs to not impose security risks, so resilient and security of supply type considerations, and it needs to be decarbonized. So affordability and COVID-related affordability concerns is one aspect of that trilemma. It's a much wider picture of just the trade-offs that decarbonization is rife with, that we're always balancing resilience, affordability, and decarbonization as the sort of multifaceted optimization problem with constraints.
And the reason we mention affordability is the fact that consumers should be willing to pay extra, the premium, to get a product that doesn't harm the environment and that is environment friendly. So that brings me to another topic, which is to what extent are we seeing structural shifts in consumer demand for ESG products, for products that are actually marketed as being green, and that's why its companies are asking for a premium price for these products?
I think that given that we're focusing in this panel on carbon pricing and emissions, it's helpful to think about consumer willingness to pay also in the context of that ecosystem. Because I described a little bit about how the fundamental problem of carbon and decarbonization is that there is a negative externality where you have production, consumption that has created harm to others. And if consumers are willing to pay for the harm that their, in this case, consumption activity is generating on others, then you have to be thinking about how is that harm being priced up that value chain as well. And so when I am a corporate and I am thinking about offsetting or about reducing the emissions that I have, let's imagine for a moment that I'm not in a compliance market, because that's the market that we spoke of before, that there are compliance markets where there are cap and trade systems, where the government decides, here's the sectors that we think are heavily polluting, and they have these certain emission quotas that we're giving them, and if they want to pollute more than that, then they have to buy those credits from others. If they want to pollute less than that, then they can sell those emission allowances that we gave them or that they had bought from before. Now you're not in that compliance market because you're asking me about consumers. And let's say it is a company like, there was a very well publicized concern, we had Vera on this panel before, about some of the offsets that Vera had been certifying that had been bought by people like Gucci and Bloomberg and Disney, in the context of them imagining that there is a ESG concern that their consumers have downstream and that they need to be internalizing in their own purchasing and in their own product selling decisions. And the concern there was that the credits had been in a way discredited. There had been some investigative journalists who had suggested that the carbon emission benefits that had been claimed for those credits were in 90% of the cases overestimated, overstated. So the per ton CO2 equivalent sort of willingness to pay that they had demonstrated in buying those credits had been against credits that did not provide that benefit. What happened to Vera in the context of that? There's not much that could be done. It was all in the voluntary space. What happened to the companies who bought them? Well, they look at other means of offsetting their carbon emissions and reducing them at source. But I think that is one example of zooming in on an aspect of, once you're out of compliance markets, then you're thinking about carbon in an even more, as it were, fluid sense, because offsets can be anywhere between, if I'm thinking in pounds, 5 to 10 to 50 per ton of CO2 equivalent, depending on which market, whether it's bilateral or multilateral that I've agreed it in, and what technology. Is it soil-based carbon sequestration? Is it afforestation? Is it something else? There's different price points. Emissions allowances come in at 50 to 100 per ton of CO2 equivalent. That's the compliance markets. But then negative emission technologies, you talk about engineered solutions like direct air capture, that could go up to, at the moment, 600 per ton of CO2 equivalent. So answering that question of how much is a consumer willing to pay and where are they paying for it? Are they in a market that is polluting and has compliance schemes? Is it voluntary? And how is the person who is selling them that product internalizing that question? It could be anything between 5 and 600, which if you were thinking about carbon pricing in an unconstrained way, could in theory form the price of carbon. Now, I'm not saying you can actually go and buy credits from direct air capture at the moment. It's not a technology that is in mainstream and deployed at scale, but it's just a really interesting answer in a sort of market and demand supply based dynamic sense of the price of carbon is based on what technology to decarbonize.
So let's just say that monetizing decarbonization process is not as easy as it looks, because there are many factors to consider, right from government tier right down to the consumer tier. Europe, when I look what European countries are doing when it comes to regulatory frameworks, what the companies are doing when it comes to ESG reporting, they've done much. In your opinion, Sahar, what lessons can we learn from European governments, European corporates' experience with ESG reporting and the overall decarbonization process?
I mean, I think going back to that question you asked, May, of risk-adjusted returns, I think that's a really good place to think about examples, actually. Because if I take 3 different countries, let's say one of them is the US for a point of comparison, and then 2 European countries. And I think about, let's talk about carbon capture for a moment. Carbon pricing is my panel. I keep bringing it back on topic. Let's talk about carbon capture. Carbon capture is one of the technologies which, in the context of carbon capture, utilization and storage, there's a lot you can talk about at the sort of upstream part about how many people are trying to capture carbon and then use it in industrial processes so that you're not trying to extract the industrial carbon that you need from in terms of virgin sources, you're reusing carbon that's been captured. But then one of the big questions that not just Europe, but is here in the Middle East as well, in the context of one of the central planks that I understand the Saudi government have for their net zero plans over the next decades, is to build transport and storage networks that will carry that carbon that has been captured away and then hopefully permanently geologically sequester that carbon. And the big question that has been asked in the context of, how do you make sure that that investment, that huge infrastructure investment, because these are new transport networks that we're talking about that need to be built, how do you incentivize that to happen? And the role of government and also of independent economic regulators in that is a really interesting case study, both in terms of the European experience and in terms of the counterpoint with the US. The US has had, in the context of oil and gas, carbon capture in utilization for a while. And it's been done largely on a merchant risk basis. So it's not regulated. You undertake your own investment and then you sort of appropriate the returns on that. In the Netherlands, when this was being looked at a few years ago, Shell and Total, 2 multinational oil and gas majors, looked at it and said, we can't individually undertake this on a merchant risk basis. The risk is too high. And we need to make sure that we can collaborate with each other. But if we do that as players who otherwise compete with each other, we might be found to be in breach of anti-competitive, antitrust type provisions that governments and regulators and competition authorities have for us. So they preemptively, and we help them with this, put together a case demonstrating the economies of scale and scope that they have in collaborating to jointly market, jointly price, jointly build this transport and storage network. So that's one example of the US took merchant risk. The Dutch said we can't, or not the Dutch, but these multinational corporates in the Netherlands said we can't do this by individually. We're going to go in it together and use our power together. And the UK, as the third example, another European country that we Brexited, big mistake. Anyways, another example, they said, we're going to regulate this heavily. It's going to be an ex-ante, RABWAC economic regulation model, which will mean that we will both limit the downside risk that you face, but that will also truncate the upside returns that you can generate. So when you think about the sort of lessons, I think the biggest lesson that I see is that when investment happens, when it comes, when the private sector intermediaries are incentivized to undertake such large-scale capex, it's because you've got, as the government or the regulator or the competition authority, that balance of risk transfer right. And that is a big differentiating factor between different European countries, that it's they have sort of overall policies, the EU Fit for 55, etc., have sort of sector-based policies for decarbonisation in general. But getting it right means really thinking about the circumstances and the risk appetites of the investors and the conditions in your country that mean that investment can happen, the capital is attracted, and it's retained.
So I still have 3 minutes before we end this session. Sahar, 10 years from today, can you pinpoint a challenge that you would like governments to have been solved when it comes to decarbonization, or a legislation that you wish it can be passed globally to help with the decarbonization process?
Ooh. I think for me, May, and this is a sort of a multifaceted answer to a multifaceted question, I think for me it is that I would like governments for their own countries, and there are obviously important lessons to be learned across borders, I would like governments for their own countries to intelligently observe where they need to be brave first. And by that I mean that the decarbonisation puzzle that we face before us, I see it as a sort of a block. It's a tower. There's 4 things that sort of make it happen. There's the underlying technology, which for each segment, each sector, each value chain, I've described how upstream, midstream, downstream, there's different technological needs. There's the sort of finance that needs to come to enact the possibility of that technology to make a lot of the stuff that is currently nascent deployable at scale. There's the regulation, and this is where the government's sort of role is coming in, that they're watching the technology and they're watching the investor appetite. And also, in the middle, government is watching that final bit, the consumer uptake, all of the redistributional implications that come, the just transition, the things that we talk about in terms of acceptance. I would like them to be sitting in the middle for their own countries and the decarbonisation puzzle, which is specific to them, of where it's most emissions intense, and saying, where do we need to be brave first? What part with our taxation, with our subsidy policy, with our private sector innovation incentives, with our carbon pricing, what part is needed in order to unlock the barriers in any part of that? Is it the technology that is stuck because we're not giving it enough certainty that it will be a technology that will win in this part? Is it the regulator that is stuck because they need a little bit more assurance that we stand behind them in providing some subsidy that they can't sort of guarantee for the private sector? Is it the consumer, an education program, or something else around the carbon pricing, which is also the incentives that we're talking about. I would just like them to be sitting and watching and saying, where do we need to be brave first, instead of just waiting for 1,000 flowers to bloom?
So if we want to, in a nutshell, summarize what we heard today, is that monetizing the decarbonization puzzle, as you rightly called it, is not as easy as one might think. And when we talk about decarbonizations, it's about building an ecosystem. And it's about building systems and collaborations between corporates, between the private sector, between consumers as well, and intermediaries. And these systems will have to be adaptable, and they have to be inclusive. This is, I think, the most important lesson that we have learned globally over the past years when it comes to decarbonization. I want to thank you so much, Sahar Shamsi, for being with us today. You brought great added value to this session and to this discussion. And thank you, ladies and gentlemen, for being with us today.